Good morning, good afternoon, and good evening, everyone, and welcome to Tax Readiness, Staying Compliant and Competitive in 2025. My name is Colin Mahan, and I'm a Director of Programs at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit improving access and knowledge in entrepreneurship to advance economic progress for all. As you're going to see in the chat in just a moment, the Nasdaq Center provides programs, resources, and exceptional mentorship to help entrepreneurs fuel prosperity, no matter where their journey begins. Be sure to check out those links and resources shared in the chat. Now I'm going to launch a few polls to take a step back and take a temperature gauge on how all of you are doing today. We use this information to guide the programs we provide for you, this global community of entrepreneurs. The first one, how are you feeling about your business right now? We use this information to guide the programs we provide for, again, you all out there in entrepreneur land. All right, looks like optimism is in the lead. Thank you for sharing in that first poll. If there are any specific topics or challenges you'd like us to create resources for, feel free to share them in the chat. We will take note. A couple more housekeeping items before we get started. First, let us know where you're dialing in from by dropping it into the chat. We'd love to see where everyone's joining us for our time together today. Secondly, we're going to have live Q&A for our speaker near the end of this session, so please feel free to submit those questions for us at any time using the Q&A function at the bottom of your screen. We'll do our best to get to as many as they can. All right, California, Wichita, good afternoon. New Orleans, love it. Welcome, everyone. All righty, in this final poll, what's keeping you up at night? We use this as our target for the upcoming months of programming, so let us know. And while you're answering that final poll, I'd like to take a moment to recognize the incredible support of our corporate partners. The work we do at the center wouldn't be possible without the generosity and belief of our partners and funders, including Nasdaq, Wells Fargo, JP Morgan Chase, KPMG, Walmart, the Asia Innovation Hub, Wilson Sonsini, the Nerite Foundation, and BPM. We're deeply grateful for their partnership, and we'll hope you'll join us in sharing that appreciation as well. All right, well, looking at the final poll results, looks like finance is in the lead, but pretty good mix of sales and marketing after that. So thank you, and you're in luck because that's the topic of our discussion today. So without any further delay, please join me in giving a warm welcome to our special guest. Gerard Narendran is a tax manager at KPMG. Gerard,
Hey, good
happy to
morning,
have you.
everybody. I'm Gerard. I'm a tax managing director with KPMG in our strategic corporate tax group. We're going to spend the next hour or so diving into the tax legislative updates that were enacted as part of the Trump administration's One Big Beautiful Bill, and touch on some accounting for income tax matters as well. I also fully realize that talking about taxes and legislation this early in the day may be a little too exciting for some of our audience members. So we'll try to save about 10 to 15 minutes at the end to talk through any tax questions you might have. Before we get into the new bill, we have to travel back in time to 2017 when the previous Trump administration passed the Tax Cuts and Jobs Act. As a personal aside, oh, sorry, I'm not sharing my screen yet here. Let me figure out how to do that. Sorry. We're sharing it before the call and then we turned it off for the video. 1 second. Okay. Can everybody see my screen? Can you put it in the chat if you can see my screen okay?
Looks great.
Okay, sorry. Okay, before we get into the new tax bill, we got to talk about Tax Cuts and Jobs Act. And back when this bill was passed, I was told it would be a once-in-a-lifetime change. As it turns out, every administration since then has passed major new legislation, albeit not as drastic as the Tax Cuts and Jobs Act. And I expect that trend to continue going forward, at least whenever the major ruling parties change control. Here at KPMG, we love our acronyms. So when I'm talking about the new legislation, the One Big Beautiful Bill, I'll commonly use OBBB or OB3. And when I'm discussing the old legislation, I'll reference it as TCJA, Tax Cuts and Jobs Act. So when the government wants to pass legislation tied to taxes, funding, spending, they have to make sure to balance all tax cuts. In order to allow decreases in the budget, there have to be offsetting increases in revenue generators or cuts in spending elsewhere. The legislative body, therefore, has to weigh the implementation of any changes and determine the long-term implications. Therefore, when Congress passes these tax cuts, they often have to decide if the changes will be permanent, such as the permanent change in the corporate tax rate to 21%, or temporary. In order to balance TCJA, many of the enacted provisions were made temporary out of necessity, as the long-term budgeting for those would have resulted in taking out other pieces of legislation in order to balance them out. One of OB3 goals then was to make it a priority for the current administration to change some of these provisions from temporary to permanent. Many of the TCJA tax components had sunset dates that resulted in adverse tax treatment later on down the line for businesses. In order to balance OB3, therefore, the new bill includes various revenue-raising measures as well, including reforms to the U.S. international tax regimes and phasing out certain energy credits. And what we start to see here is a common theme between TCJA and OB3, which is using the tax code to push priority agenda items for the Republican administration. Bringing businesses back to the U.S. is one of those priorities, and by increasing taxes on offshore business activity, it incentivizes companies to take a deeper look at their structure to determine if there are tax advantages that can be undertaken. In a similar vein, green energy that previously generated tax credits for companies will be going away. So while the bill provides sweeping tax law changes, its effect on the accounting for and reporting of income taxes is a little bit more subtle than those experienced with the reduction of the corporate income tax rate and the transition tax under TCJA. The provisions within OB3 are complex, and they do affect the current and deferred taxes, valuation allowances, etc. It's just not as stark as what we saw under TCJA. With the big piece being that change in the tax rate, which resulted in a revaluation of all deferreds as a discrete item. In addition to the accounting and financial reporting implications of the bill, entities also need to understand the immediate and long-term effects on both cash taxes and the effective tax rates. So we'll touch on all that stuff as part of the accounting for income taxes piece here. On this slide, we can see a summary of some of the main changes that will affect corporations. We're going to dive into some of these in more detail, but I want to point out that some of the accounting effects. Generally, we expect the domestic provisions related to bonus depreciation, research and experimental expenditures, and business interest to decrease cash taxes in the short term, depending on entities' elections. On the other hand, the international provisions related to global intangible low tax income, foreign derived intangible income, and the base erosion and anti-abuse tax, as well as the sunsetting of those energy credits, will increase cash taxes. One other kind of discrepancy between the two is that a lot of the changes under OB3 are for, or the domestic side, are temporary differences, meaning they don't impact the ETR, versus the changes on the international side will in fact hit the ETR. So when you're thinking about how to present these in your financial statements, that's something to keep in mind. Okay, we're going to go through some of these domestic tax provisions first, and we'll get to the international items. As you'll see, most of the domestic provisions are beneficial to companies, or they at least allow for some leeway in tax planning to best benefit them. 174 costs. So many of you will recall the recent change to the tax treatment of research and experimental expenditures, commonly referred to as 174 costs. Prior to OB3, companies were required to capitalize all 174 costs. Domestic costs could be as low as 5 years, and foreign 174 costs would be capitalized at 15 years. Under OB3, companies are still required to capitalize 174 costs related to offshore expenditures over a 15-year period, but now they have the choice to either deduct or capitalize domestic expenditures. Further, for those domestic costs that were previously capitalized, companies can elect to either continue recovering those costs via the original life of the capitalized asset, or they can elect to recognize those costs over a 1 year or 2 year period. One other item to point out is that companies may still choose to capitalize the new domestic 174 costs if they should so choose, which can be an effective way to reduce tax losses generated in any given year. For example, taxpayers may not benefit from immediate expensing of domestic R&E expenditures in a given year if that immediate expensing increases an existing loss or generates a large net operating loss that would be limited to 80% of taxable income in future years. So let's take a step back and think about that, right? If you are deducting costs in a certain year and it's just going to build on your NOL, but in the future that NOL can only offset 80% of your taxable income, capitalizing that cost in the current period may be beneficial, because then down the line, when you take that amortization expense, although it's not the full amount, it could be it'll act as a full offset against taxable income versus an NOL, which can only offset 80%. Another situation we sometimes see with taxpayers is when there's a certain tax benefit that could be made or taken by the company in the event of being in a taxable income position. For example, companies that have tax credits that are expiring or are taking a Section 250 deduction on their return related to FDII, when that's only allowable for companies who are generating tax in the current period. So there's interplay there that you have to consider, and that tax planning needs to be taken into consideration. From an accounting perspective, companies would have previously put up deferred tax assets for the differences in carrying value between the book and tax treatment of these costs, right? Generally for books, such R&E costs are just fully expensed and offset on the P&L. For tax, if we had to capitalize them, we set up a DTA that was going to amortize down over time. Now, some companies do capitalize 174 costs, where 174 is a tax term, but those research and expenditure costs. In that situation, you may have a book carrying value that's close to the tax carrying value. So it'll just be an experiment within your company to see how those costs are treated and what the impact of fully expensing those will be. When you're thinking about a VA and a DTL, if you bring down a DTA and books has previously capitalized those costs, you can use that DTL as a future source of taxable income when considering VA planning. So there's, if you should choose to accelerate the recognition of those costs and recognize that DTA, you should certainly make sure to take into account the VA consideration and the timing of reversals for temporary differences. The change in tax accounting method for R&E expenditures is from a permissible tax method. So an entity accounts for the change when it commits to making the change, which varies on a situation by situation basis. Many companies are considering, looking out into the future. Well, I don't know at the time of provision. I'll make that determination when I've had more time to do tax planning and when I'm actually filing the return. But it could just be based on intent prior to reporting the change on a return. So that's at the company's discretion when they commit to making that change. The accounting for the change could include adjusting the income taxes receivable and payable, adjusting the deferred tax asset and liability, and potentially even derecognizing unrecognized tax benefits or UTPs. Okay. Next up on our list is the 163J interest limitation. As part of the TCJA sunsetting rules, the mechanics around 163J changed to create a greater allowable limitation. This requires a little bit of a breakdown of the interest limitation calculation itself. I see in the comment there's some stuff here that sounds very complicated. And questions on DTA. I'll answer all those questions towards the end, but real fast, just for benefit of the audience. A DTA is a deferred tax asset, and that's when your tax carrying value on your balance sheet is greater than your book carrying value. So when you have a tax item that will be a benefit in the future. So 163J, the calculation is pretty straightforward. Companies are limited to a certain percentage of their adjusted taxable income. And the adjusted taxable income, you can see the components here on the screen. You originally calculated as EBITDA before adjustments for depreciation and amortization were sunset over time as part of the TCJA legislation. So OB3 brings those adjustments back in, which means for capital intensive companies, the change in adjusted taxable income by using EBITDA instead of EBIT results in a greater allowable interest deduction. So, in other words, because we're expanding our limitation by allowing for that depreciation add back, we're going to have a greater amount of interest that you can deduct. One final note here on 163J is that there is a lot of tax planning for companies that are subject to other US tax regimes. For example, and we are going to get into this in greater detail, companies that are subject to BEAT will have to consider how the additional allowable interest deduction may impact their determination of their BEAT liability and consider what strategies might be used to best optimize their tax footprint. We're going to get into bonus depreciation in a second here, which also has impact on the 163J calculation. So a lot of indirect tax implications that stem from this change, and there's a domino effect to all of them. So certainly pay attention when considering tax planning for such matters. Okay, bonus depreciation 168. This is a little bit more straightforward, and most of you who are at least passingly familiar with taxes are probably familiar with it. The Tax Cuts and Jobs Act did allow for 100% expensing of capital expenditures for qualified property, again with sunsetting rules in place to eliminate the allowed percentage of bonus depreciation over time until it completely phased out in 2027. And you may recall that bonus depreciation has a long history of last-minute changes. Even before TCJA, we would often see late legislation in December, like literally the last week before the next calendar year, that would allow for bonus depreciation for the upcoming year. So the government has often used it as kind of a lever to incentivize business activity, especially in times of economic turmoil, because when you allow for this bonus depreciation, it generally reduces taxable income, right? It incentivizes companies to implement and spend in the US and put property into service and create more jobs. Now with OB3, this 100% bonusing is brought back. But again, we could see that it can be used as a lever for future legislation. As I was saying earlier, when you have to balance budgets, you have to take, if you're putting something in that benefits, a company, you have to take something out to balance it out, right? So if there's a new, tax cut that the government wants to pass, it's very likely that they could say, well, let's scale back the bonus depreciation to 80%, 60%, or even lower. I mean, we've seen it go away entirely in the past, and then when it comes back, we see that corresponding boom in companies spending, because you can immediately see the effect, the reduction of your taxes as a result. Similar to the other domestic provisions, which are generally considered beneficial to taxpayers, there are some accounting and domino effects that result from this change. Taxpayers that elect bonus will likely have a greater net carrying value of their fixed assets for books versus tax. So going back to that DTA, DTL, deferred tax assets and deferred tax liabilities, your fixed assets, when you take bonus, your tax carrying value is zero, right? Because you've fully expensed that item, versus books generally capitalizes it over the useful life of the asset or some other method. So there's some tax planning items to consider here. And again, that VA valuation allowance analysis will require fresh eyes, especially when you consider the timing of the reversal of the deferreds. And we won't get too far into the VA discussions here, but when you think about VA, you have to consider, future sources of taxable income, meaning increases to taxable income. And when you've fully expensed your capital expenditures and costs, that's when you might see, an increase on the book side, because books is going to continue taking the book deduction, on the P&L, and then tax has to add that back. And then once again, I'll reiterate that the bonus depreciation will also have interplay when determining that ATI, which is used for 163J purposes. One other point here, similar to in years past, when you're doing the consideration of the bonus depreciation, taxpayers can opt out. They can elect out of bonus in any given year for any class of property. So when you're trying to maximize your tax planning considerations, oftentimes companies will want to get as close to the line without paying taxes as possible. And so if you're approaching that kind of taxable income calculation where you're close but you're not quite in a tax income position, or vice versa, where it makes sense to maybe take a certain class of property and elect out of bonus on that and just take a ordinary tax life uh, depreciation for that, meaning spreading it out over 5, 7, 15, or 39 years, which allows you to kind of play around and get closer on the planning side. Some other domestic provisions that are going to impact companies. I briefly mentioned the green energy changes. Uh, One of the bigger ones for public companies is the limitation on tax deductibility of excessive employee compensation. Basically, the government wants to limit the amount of annual deduction for compensation paid to covered employees of publicly held corporations to $1 million per employee. Beginning in 2027, Section 162M is going to expand to include the 5 highest paid employees for each tax year. And OB3 adds in an entity aggregation rule. So basically, OB3 provides that remuneration paid to a specific covered employee by any member of the controlled group is aggregated to determine the loss deduction for amounts over 1 million. That allowable deduction then is allocated between applicable controlled group members. And for affiliated groups of U.S. employers, this generally codifies the current regulations that take into account all members of the affiliated group in applying the deduction limitation. And clarification of the allocation method it's probably going to be limited in its effect. And that's on the domestic side. However, for multinational organizations, these provisions will probably limit the deduction available to the U.S. members of the group of related corporations in the event that all or a portion of the $1 million compensation deduction for compensation paid to a covered employee is being allocated to non-U.S. control group members. So this is, again, we were talking about pushing America forward as an agenda bullet point. This is another example of that, where the US side domestic entities will probably not see too much of a change here, but when you're talking about those huge multinationals with controlled group members and related parties, that's where you could see some of this really coming into effect. Additionally, the tax deduction for charitable contributions, it was previously just a limit of 10% of taxable income. While that kind of ceiling limitation is still in effect, OB3 introduced a 1% floor limitation such that aggregate contributions must exceed 1% of the corporation's taxable income. So while the excess of the tax of the allowable deduction is taken as a carry forward as a tax attribute, if that aggregate contributions do not exceed 10% in the current year, you do not get a carry forward of contributions disallowed due to the 1% floor. Okay, that's really the main points for corporations on the domestic side. Again, the domestic side is really aimed at pushing domestic U.S. business, right? Operations. They want companies to shift their overseas models and bring business back to the U.S. They want more production, manufacturing in the U.S., and they want to incentivize companies to do so. Conversely, on the international side, it's really the opposite, right? We see bonus depreciation, we see R&E expenditures. Those are examples of how companies can really push on the domestic front. But on the foreign side, there's going to be a lot of more, I'll call it punitive tax regime. So as we get into that, just keep that in mind here. And as we shift over, I do deal with multinationals and cross-border transactions, and I like to think I'm smart enough to know my own limitations. But I'll do my best to answer questions. There are certainly going to be aspects of the minutia here that I do not know off the top of my head. I'm hoping there's no tax experts out in the crowd who will start to quiz me and get into the details here. But we will, if there are questions that we don't have the answer to, we will take our time and get to the right answer. So the other thing here is, if you thought there were too many acronyms before, I'm going to sincerely apologize, because sounding out all of the words in this section would probably take us well over time, and we're already halfway through our time limit, and we got to save time for questions. So I'll try to speed it up a little bit, and just I apologize for all the acronyms that are going to come out. So for those of us who were around during the TCJA enactment back in 2017, 2018, you will probably remember the confusion around implementation of the international aspects of the changes to US tax law. For those of you who don't remember it, we will politely say that all parties, from taxpayers to the IRS to Congress, were not prepared for all the implications of the change. My personal favorite was, there was a one-time repatriation tax, and so basically a tax that said, you have all these companies underneath the US structure operating in all these different jurisdictions. We're going to tax you on their earnings cumulatively over the lifetime of those controlled foreign corporations, which are commonly referred to as CFCs. So Congress passed this law saying they were going to tax companies for all their history of earnings overseas without any warning. And the calculation had very minimal guidance, and it was so bad that they didn't even have a form to put it on the return. So taxpayers were required to come up with their own form and just stick that in the return, just to kind of give the IRS something to look at to say, this is what we calculated as our off-seas earnings that are being repatriated. So when you compare it to OB3, that kind of mess makes these changes look like a blessing. In general, the changes under OB3 are modifications to the existing tax regimes that govern foreign activity picked up on U.S. tax returns, as opposed to entirely new regimes. So in fact, the next three kind of bullet points or slides that we're going to hit here, GILTI, BEAT, and FDII, those were entirely new under TCJA. Under OB3, these regimes are each modified in some way to kind of make things more straightforward, but definitely more complicated as well. So we'll get into it here with GILTI. So what is GILTI? It's Global Intangible Low Taxed Income. And it was introduced as part of TCJA, served as a key pillar of the U.S. international tax policy. Its primary aim was to tax excess income earned by controlled foreign corporations, CFCs, that exceeded a normal return on tangible assets. So under TCJA, a U.S. shareholder of a CFC, meaning a domestic entity that owned a foreign corporation underneath, was required to annually include in income a GILTI inclusion based in part on the CFC's tested income, regardless of whether that income is repatriated back up to the U.S., right? So it's saying, yes, you earned this money overseas. Prior to TCJA, that income that was earned overseas could be permanently reinvested. Now you still get taxed on it in some way, shape, or form. GILTI is currently taxed at a rate of 10.5% by means of a 50% deduction under Section 250. This calculation and some of the subsequent calculations we're going to talk about are very complicated and require, a more than a passing knowledge of the international provisions of U.S. tax. So we won't get too far into the details. Just know that 10.5% was going to be modified in the future, because that Section 250 deduction was going to be modified down to 37.5%. Under OB3, GILTI is going to be modified and replaced with what's considered net CFC tested income, NCTI. We just call it necktie. It's easier to pronounce than NCTI each time. So necktie is a little bit more straightforward mechanically, but it continues that trend of attempting to incentivize businesses to increase domestic activity as opposed to shifting operations offshore. The key changes from GILTI to necktie are: there's an elimination of the previous Q-buy exclusion. There's no deduction allowed for net interest expense. U.S. shareholders must now include their full share of net tested income from CFCs, regardless of how much capital investment or debt the CFCs have. So that one is important because this effectively changes how U.S. companies fund their CFCs. It really impacts capital intensive or debt financed CFCs because now that entire amount is included, right? Especially with that elimination of the deduction for net interest expense. There was somewhat of an offset here in order to mitigate the impact of the rules. There's a change in that Section 250 adjustment. It was previously going to go down to 37.5%. Now that Section 250 adjustment is set at a 40% offset, and companies get a slightly more beneficial treatment for foreign tax credits as well. Okay, here on BEAT. BEAT is one I'm a little bit more familiar with because there's quite a lot of tax planning that needs to be done around BEAT. Under TCJA, you had certain taxpayers that were levied an additional 10% on modified taxable income. And that goal of BEAT was in line with the America First agenda. Modified taxable income is based on adding back certain cross-border payments sent by domestic taxpayers to foreign-related parties, right? So the BEAT aimed, to prevent income shifting by disallowing deductions taken in the U.S. for outbound payments, right? And we're going to get into, some of the more common examples here, but I'll highlight interest, which is, the big one for a lot of companies. When you have a foreign parent overseas that funds the expansion of U.S. operations, they often do so via a debt structure, debt financing. And so you have a U.S. taxpayer who is, setting up operations, but also sending deductions back over to wherever their parent company is held overseas. And that just means that deduction offsets, you have losses or you have income in the US that you're offsetting against, but the deduction, the actual income for that interest is picked up overseas by that, foreign related party. So it's a 10% tax that was applied against your modified taxable income. And that was set to increase to 12.5% under the TCJA sunsetting rules. The BEAT rules under OB3 changed that. They said instead of a increase to 12.5%, we're going to change it to 10%, and we're going to allow for tax credits to offset that modified taxable income, which was also planned to be sunset out. So this one, again, it's pretty straightforward. However, I want to note the interplay between all of these changes. As companies offset and analyze their tax footprint, there's interplay between bonus depreciation, 163J, and BEAT, right? So, for domestic entities making cross-border interest payments, for example, you may get that greater allowable interest deduction due to the expanded 163J limitation. But then those payments will be added back in the company's calculation of their modified taxable income for BEAT purposes, and that could push them to be a BEAT payer. So it's worth doing some planning around that interplay to make sure that you optimize your tax footprint. Final point on BEAT is that the additional BEAT tax is a permanent tax on top of the company's ordinary federal income tax. This is in contrast to the new corporate alternative minimum tax regime, which generates a CAMT credit for additional taxes levied. So when you think about it, BEAT comes in as a permanent tax. If you are subject to CAMT, taxpayers will see a no impact on the ETR because that CAMT additional liability results in an offsetting CAMT credit that kind of nets out. So it's a net zero impact on your ETR. Okay, I'm seeing in the chat that we're getting a little too complicated here. So I think we will speed right on through the FDII and FDDEI, which is for companies that are getting a benefit for, again, foreign CFCs that are held overseas and their income and tax structure. I will just point out that OB3 minimizes the impact of this and makes it a little bit harder for companies to get a benefit here. So we'll speed past that. One other interesting point that I just wanted to make sure I mention here is that there were originally certain retaliatory taxes that were planned to be included in OB3 to counteract certain other tax regimes, including a super B top-up tax. And instead of codifying those retaliatory tax measures, what we saw is that the administration chose instead to go with trade policies and tariffs, which were, specifically levied against certain countries, right? So the original retaliatory rule, Section 899, it would have been broadly applied to more foreign countries, whereas tariffs and other trade treatises are more targeted and applied to individual specific countries. Okay. And then finally here, what we see are the dates that apply for the tax provisions that we just got implemented here as part of OB3. Okay, so I realize I may have lost some of you with all that complicated tax talk. I apologize. We're going to briefly touch on the accounting for income taxes. It sounds like there's not a lot of you that are really dealing with multinationals and OB3. So I'll try to, again, speed through that portion and then just talk through some of the new ASU. One thing to note here is that companies, for those of you that work for public companies or companies that are required to publish tax footnotes, OB3 was passed on July 4th, 2025. So many companies had closed their books for the period ending June 30th, 2025, and their financial statements did not integrate all of those changes simply because there wasn't time. So many companies just chose to include a statement discussing OB3 in broad strokes in their financial statements, effectively stating that the impact of the new tax law was still under analysis. And then the treatment for those changes is a little bit interesting. It depends upon whether such changes impact current year income taxes versus deferred taxes. So when you think about your annual financial statements, income tax expense from adjustments to DTAs and DTLs due to these tax law changes are disclosed. And if an entity applies a beginning of the year approach in the interim period of enactment, it still needs to determine, the adjustment to deferred taxes as of the enactment date for the annual financial statement disclosure. I'm going to try to skip a little bit here because we do get more technical, and I see from the comments that that's probably not what the intended audience is looking for here. Just maybe, if you guys don't mind, if there's anybody that does want some of this, is after this presentation, we will be distributing the slides and also links to other materials. So there's certainly quite a lot in terms of what to absorb and what may impact your business or your company that you work for. Again, I don't want to beat you guys over the head with information that is maybe not as useful for you. I'll try to kind of pick and choose here what may be more applicable. Let's see. So we'll go back to those domestic provisions. It sounds like those at least may impact some of you from a tax perspective in your business. And this is where I think there was a question earlier on DTAs and those items. With those domestic provisions, we talk about how those are generally considered more favorable for taxpayers, right? Depending upon what elections a taxpayer takes, you would plan to see a reduction in your current tax, cash taxes, or an increase in your tax attributes, meaning your NOL carry forward, your net operating losses, which is historical losses that are carried forward, which can be used to offset against future taxable income. Conversely, when you do this, you have an increase in your DTL for your financial statement carrying value and the tax basis of the property. Again, I'll reiterate this point. You have your tax value and your book value, and the difference between those is your deferred tax asset or liability. When your tax carrying value is greater than your book value, it's a tax asset. When your book value is greater than your tax value, then it's a tax liability. So what we see here is that you'll get a increase in your DTL for these beneficial items, because what we're doing is we're accelerating the tax recognition of these expenses. I'll try to skip a little bit more. Same thing for 163J. Because we're getting to deduct this interest in general, you're recognizing your DTA, which was put up, and hopefully seeing a reduction in your income taxes payable or an increase in your NOL carry forward. On the international side, most of these are treated as permanent or special deductions. So while those domestic ones are all temporary, which have a net 0 impact on your ETR, the international provisions generally do have a direct one-to-one hit on the ETR. So whatever that increase is for your BEAT liability, for example, that's an increase in cash taxes on your effective tax rate. Okay, finally, what we want to get into here is the uncertain tax position. I'll go back to that Tax Cuts and Jobs Act, the repatriation tax anecdote that I had earlier. What was funny about that one is that even though the IRS was not provided with the underlying supporting calculations, they were just given, whatever way the taxpayer wanted to present it to the IRS, they just put that number on a white paper and sent it in. The IRS seemed to think that they had all the information. We saw a lot of notices applying adjustments to that tax. So, in the absence of guidance from the IRS, what we should see is analysis for companies as to the likelihood of a position being upheld under examination by the IRS for any changes to tax law. So just keep that in mind. If the IRS can come back and challenge any position taken, any determination by a taxpayer is subject to that scrutiny from the IRS, and it is the taxpayer's responsibility upon examination to prove and determine that point. Which is often why we see taxpayers get opinion letters from firms to kind of shore up their documentation and position in the event of an IRS audit. Okay, last section that I'll kind of try to speed through here. It sounds like I don't know how many of the audience participants are subject to the new ASU accounting standards update from FASB, but the purpose of this new ASU 2023-09, it was to enhance the transparency and decision usefulness of income of the income tax disclosures. So the ASU expands the annual income tax disclosures to address investor requests for more information about how the tax risks, tax plannings, and the entity's worldwide operations affect taxes. The effective tax rate and cash tax flows. What cash taxes are being paid in what jurisdiction. As many of you may be aware, the ASU's effective date is rapidly approaching. So public business entities with calendar year ends must provide the enhanced disaggregated disclosure requirements in their December 31st, 2025 financial statements. Again, I won't get into the details here. It seems like this may not be exactly what you need here, but essentially there was a lot of aggregation on an ETR that was just pushing line items into buckets. This breaks those out, makes it clearer to see where companies are operating, and in the event of you having these foreign jurisdictions that are accumulating taxes, it helps to see how companies are generating income and taxes in those foreign jurisdictions, as opposed to just understanding the U.S. tax footprint. You may have seen it in OTP or on financial statements. There was always this bucket for other taxes at statutory rates other than federal, and it would just be an amalgamation of all these other jurisdictions, and it would drive me crazy, right? Because it was an audit risk. There was no good way to reconcile it. Now the expanded reporting requirements make that line item much clearer. There's determination of what goes into that using a 5% threshold when considering that disaggregation. There's also a lot of interplay between OB3 and the new ASU. These are going to be categorized into different buckets, which I have here. I won't get too far into these because, again, I don't think that this audience may be the intended audience for this, but just keep that in mind. And yes, we will distribute these slides so you have them just in case. So the final point here is that there is going to be, similar to interpretation of tax rules without stringent guidance, there's going to be some judgment at play here when determining what falls into what bucket. These could be categorized under different rules. You can see the language that we use here on this final arrow is that cross-border tax laws may be used, but that's because there is some interpretation that can be applied by taxpayers. So I apologize that this presentation appears to have gone too quickly. We were trying to cover a lot of materials under OB3. Next time we will definitely try to focus in maybe on just the domestic or just the foreign. But thank you guys for your time. Do we have questions in the audience that I can help with?
Yeah, thanks, Gerard. And yes, all of this is complicated, but all good things. That's why we have smart people like you to help us through the details. So thanks for that presentation. We've got some questions in the Q&A. If you want to stop sharing your screen so we can see your smiling face. And we got some good questions for you, Gerard. So thanks again for that. Let's see. And you talked a little bit about this, but there's a question here. Do these laws impact all sizes of businesses the same?
So no, they do not. A lot of the tax rules apply. There are small business exemptions. And I'll focus more, excuse me, on the domestic side here. Sorry, I've been talking a lot. On the domestic side, 163J is the big one. Small businesses are exempt from 163J, and there are rules around that. So the interest limitation may not come into play. Same thing with the BEAT regime. It's for taxpayers that exceed a very high threshold. Corporate alternative minimum tax is the same. Some of you may have heard of UNICAP or 263A, which applies to the tax accounting for inventory. All of those have different exemptions and exceptions that may be applied for small businesses and for other reasons as well.
So, another question here. How does this affect small businesses filing 1120s or 112? Yeah.
1120s. Yeah.
1120, sorry.
Are the corporate tax returns. Yeah. Now, most small businesses, and this may be a presumption on my part, most small businesses are not going to have controlled foreign corporations underneath them. So most of the international provisions will not apply, as well as the cross-border transactions. However, 1120 reporting is very important, and there are certainly parts of this that will come into play. More commonly for small businesses is, I think it's on page 4 and 5 of the 1120, you have what's called Schedule K. We tax nerds, we know too much about the forms and what they entail. But within Schedule K, it has questions about each of these sections: corporate alternative minimum tax, 163J, a whole bunch more. On those sections, it's a taxpayer's requirement to be checking those boxes to appropriately inform the IRS that you are not subject to those limitations. So, I imagine most small businesses are not going to be subject to CAMT or BEAT. All you have to do is check the box on Schedule K of the 1120 form. That prevents you from having to file additional forms proving that you don't have a liability related to those pieces.
Awesome. Another question here. Are the energy incentives being totally phased out for all businesses?
No, not for all businesses and not all energy credits, but there's certainly a lot there. And what we can do is there's a lot of energy credits out there. So we will provide a kind of a KPMG readout of what the summary of those are. What I would say though is you should check the notes about when those expire. Some of the energy credits do go away at the end of the calendar year, 12/31/2025. So in the event that your business or even you personally want to take advantage of some of those, that you should certainly think about doing so. So for example, solar power, some people bought EVs, that one expired as of 9/30, electric vehicles, but the solar credits, I believe, are still intact for individuals and homeowners as well as businesses. So certainly just take a look at what the changes are and when those sunset rules apply so that you can best maximize those.
Awesome. Got a general question here. So when doing taxes for a small business, how do we stay ahead of everything? So for our
Yeah.
this is too much information. Like, where would you recommend that they come, to learn more, to stay on top of it?
Yeah. No, so the great thing is, and this is not just KPMG, this is probably all public accounting firms and most likely smaller, more boutique tax preparers and tax law firms. We distribute not only information on a regular basis, and you can sign up for our distribution list, but you can also sign up for our webcasts and items that would particularly apply to you. And when you sign up for those distributions and those webcasts, and again, this is probably true across the board at all other firms and other businesses, you can choose which ones are most interesting to you, which is probably small businesses, in your industry, whether it, whatever that industry may be, industrial, manufacturing, etc. We can certainly direct you to the right resources for what you're looking for. And then the good, the optimistic view here is that your business grows and you'll need some of these more nuanced tax technical provisions as you grow, because your business is just booming and these will start to apply to you.
Yeah. Perfect. Okay, let's see. Um, how is a small business defined under these rules?
That varies. Each regime has its own exemption or exception. It's usually generally either based on revenues or your taxable income. So, for example, the BEAT regime is based on a $500 million gross revenue threshold. The UNICAP 263A1 and 163J are based on a much, much, much lower threshold. So it just varies based on what regime you're talking about, and if there's any specific one, we can certainly point you in the right direction.
Awesome. Let's see. If you're a founder watching this, how should you gauge whether or not your business model is helped or hurt by this bill?
Well, I will say if you're a small business owner or a new founder, you're probably going to be benefited by the domestic provisions and not at all impacted by the foreign provisions. So you're probably in better shape than large multinationals. The expensing of depreciation, the bonus depreciation is really beneficial for taxpayers, because anything you put in, whether it's buying machinery and equipment or I don't know, specialized tools, etc., those can be fully deducted on your tax return, as opposed to spreading that cost out over a capitalizable period of 5 years or 7 years. So that piece is probably going to be more beneficial for small business founders. And there are other tax planning rules out there that new business founders and small business owners should definitely take advantage of. So talk to your tax provider, because the most important thing is always tax planning, right? We can always plan for the future and advise and kind of model things out. What's much harder is after something is done is to go back and say, well, how does this affect my taxes? Because at that point it's done. There's not much we can do around it.
Yeah. Awesome. Oh, we're almost at time, but there's some good questions in here still. Let's see. What about importing a material that goes into manufacturing to a product domestically?
So that would probably be at minimum a 3-hour webcast all of its own, talking about tariffs. So I'll give you the short answer for the items we discussed, which is that there are rules changing around the importation of cost of goods sold, meaning inventory and sourcing of supplies that go into items that are produced within the U.S. Um, the main item to keep in mind is the BEAT regime. Again, if you're a small business taxpayer, it's doubtful you're going to hit the $500 million 3-year average for the gross receipts test that makes you a BEAT taxpayer, or means that you have to go down the route of calculating your BEAT tax liability. But that would be the main one that applies to you. However, tariffs are going to be the area that really starts to impact cross-border transactions when you're talking about importing materials and inventory. So we have a huge trade and customs practice that deals with exactly that, analyzing, tagging, looking for what items might have exceptions applied to them, et cetera. And really, to be frank, keeping up with the changes, because as we've seen, um, tariffs are a tumultuous area, and they can change, not even on a day-to-day basis, on an hour-to-hour basis. One day we might be levying additional tariffs on Canada. One day it could be, taking them away from Mexico. So we'll just see, how those continue to play out. The most important thing there is just staying informed, right? You can't control anything that's happening there other than maybe writing to your congressperson and trying to get your voice heard. Shout out to election day, but that's the most important thing, is just paying attention and really monitoring your situation, so that if tariffs do apply to your business, you are aware of them and planning accordingly, because what you don't want is to get hit with tariffs after the fact that you have not planned for.
Yeah, that's great advice. Let's see. Let's see if we can get one more in before I get to key takeaway from you, Gerard. But all this is really good stuff. Could you please explain more about the qualified property for 100% bonus depreciation? What's the eligibility?
Sure, I won't. Reading that would be probably it'll put everybody back to sleep again here. What I will say here is that most property that is new, and I believe used as well under the OB3, I'll have to go back and check on that, is considered qualified property, meaning the only restriction is that the property must be placed in service in the tax year. So buy purchases of equipment, purchases of certain leasehold improvements, certain property, real property, like buildings, those may be eligible. I would just suggest you consult with your tax advisor. But in general, what we're seeing is most of the capital intensive type purchases by businesses are going to qualify for that. So it's certainly beneficial. But again, plan it out, because if you're in a position where you're starting your business and you're generating, startup costs and organizational costs that push you into losses, it might be more beneficial to capitalize that fixed asset spend and spread it out over time, so that you continue to get it in the future at 100% offset of taxable income, as opposed to 80% under the current NOL rules.
Hmm. Awesome. Well, Gerard, I know we could have gone for 3 hours for this, but I really appreciate the time and you sharing some of the insights on the new tax bill. Really, really appreciate it.
Yeah, it was my pleasure. Again, we will distribute the materials. We will distribute additional materials that hopefully help you. I would say, feel free to reach out individually if you have questions, and we can talk. Although, we do have restrictions about providing tax advice to, not non-clients, but generalities about, how these rules work, I'm sure we can figure out a way to answer them similar to this Q&A session. So thank you guys for your time. I apologize if some of it was not applicable to your particular business situation, but hopefully you learned something along the way.
Amazing. Well, I definitely learned and really appreciate you joining us. And for those of you who are still on, thanks for joining. We've got a bunch of great webinars coming up, and we look forward to welcoming you back to those. Hopefully, this was informative. And Gerard, again, thank you so much for the time, and we look forward to seeing how all this transpires. Thanks again.